Welcome. Thank you so much for joining us on the Nest Edge. This is where we bring you the latest and greatest of what's going on in
Hmm.
the markets, economy. Yes, the latest and greatest, Sean. Sometimes I have to convince this one. Of what's going on in the markets. We usually just pick a topic and go with it. Something that's going on. These webinars are for educational purposes, so anything that we share are opinions and are not considered investment advice. If you are new to us and would like some personalized investment advice, a review of your portfolio, we'll be glad to schedule a one-on-one and help you out. So for today, you can reach us at info@nestfinancial.net. Feel free to shoot us an email with some times you're available, what you're looking for, and we would love to sit down with you. For this webinar, I have Sean McDougle joining us. He is our Chief Investment Officer, aka the Mastermind at Nest Financial.
Oh, gross.
Today, if some of you have read this past newsletter, Sean talked a lot about the Fed. Yes, the Federal Reserve, very fun topic. But there is a bunch of buzz going on about what the Fed is doing, running their mouth. And Sean, we wanted to I'm sorry, Sean wanted to share about, what the Fed really does and what they're doing now. And so in the newsletter, for a quick recap, the Fed high level controls money circulation and interest rates. They aim to keep unemployment low and control inflation. Not so much in 2020 or 2021, as we saw. Inflation is still pretty high, but kind of getting better or, slowing down a bit. As you know, for about 18 months, the Fed was in denial that inflation is here to stay until they finally admitted it and started to attempt to do things about it, like what we're seeing now with the various rate hikes and a lot of talk from the Fed, continuing to increase those. So, Sean, what do you have for us in terms of what you shared in the newsletter about, their attempts to cool down inflation? What's going on there?
What do I have for it?
Yeah, you mentioned, the Fed is trying to cool things down, but a little too rapidly when things are cooling down naturally.
Yeah,
So,
I guess that's my biggest complaint. As you mentioned, they screwed up by calling it transitory and ignored it. And now they're screwing up again by coming in too late, and they're going to make the same mistake they did in Q4 of 2018, which do rate hikes into an economic slowdown. That never works out. We're in what we call quad four, growth and inflation or cooling, and that's the worst time possible to tighten into. And they're going to screw it up. For multiple reasons, they decided this was the best thing to do. We'll see what happens, but I know where my money's at.
so with
Screw
this
it up.
intense cooling, what was that, Sean?
They're going to screw it up.
Well, with this intense cooling and huge effect on trying to cool down inflation, our portfolios, that clients are invested in, are those set up, to take that deep dive? Well, the deep dive of possibly inflation, pulling back dramatically.
Yeah, we're positioned for a quad four for sure, slowing growth and an inflation without getting too. I don't know if I went into this on the article. That was like, it felt like a lifetime ago. Every day has been a battle lately. From deflation to disinflation. Deflation is inflation materially cooling. Disinflation is the rate of change is slowing. So it's still rising, just at it's still up, but the rate of acceleration is slowing. So that's what we are positioned for. A lot of gold, a lot of US dollars, a lot of cash, and treasuries.
All right, and I know that the CPI numbers came out. What's that telling us?
Exactly what I've been whining about for a while. It's already cooling. So to the numbers today, so these are our March, no, they were April numbers. Um, April came out with headline CPI at 8.3. In March, it was 8.5. So again, like I don't. Well, I understand why the Fed gets as talkative as they do. So they think they're, they have the hand of God and they're just going to bend economic reality, and they think they're more powerful than they are. No, I'm not saying that they're not powerful. What the Fed was originally designed to be and what it's turned into is like they are just too involved. They're way too damn talkative. They need to shut up. They need to only talk when they go in front of Congress. I should never see a CNBC guy being interviewing someone in the Fed. Get off TV. But that's what this thing has turned into. It's a political machine, a resume builder, and people want to get out there, make a name for themselves. So they want to puff up their chest. Like, oh, this inflation that we're experiencing that said didn't exist. I'll fix it. Like, no. Like that. It's the one kind of beautiful thing with capital markets is if you leave them alone, they'll mean revert, which is self-correct. They will fix themselves. So we're already seeing that process starting. Topping and bottoming of anything is not a single point in time; it's a process. So we're already there. So they're going to kill demand with these rate hikes and slow the economy. But instead of like maybe just turning the gasoline off, they're going to throw, fire retardant on the economy. Just they are going to cause way more harm than help by slowing this inflation things. It will self-correct eventually. We'll see. I think the bond market is already pricing in or starting to reverse that. They think the Fed's going to blink. That's essentially what we're seeing in the bond space. The bond space sniffs things out way faster. I've said that 100 times, but that's what we're starting to see is the treasury volatility that we've seen the last few, I don't know, let's call it 2 months, 3 months. It's starting to cool down. The bond market knows the Fed's going to blink. And I think we get another 50 bip rate hike next month. That might be it. I think they're going to blink, and maybe another 25 bip after that. But things they're going to. I've said this jokingly on a few client reviews and phone calls that like I think they're going to do rate hikes until something breaks. I don't know what that is, but I think that's the line. Powell is he's his back. The guy's worth $100 million. He's a private equity guy, so he understands the plumbing and the mechanisms, and he definitely gets texts and phone calls from his buddies if they keep doing these rate hikes until when it's so obvious that we're going into a slowdown and inflation is cooling on its own. There's no reason to be doing these rate hikes, but they want to puff up their chest. That's kind of how that speech went last week. It was last week. Them saying, they're going to be a fighter of inflation. They're going to, be a warrior and help out the, common man of America by making it's just I giggle when I watch these guys talk because it's just like, what the hell are you talking about, man? Like it's cuckoo birds up there just grandstanding a lot. But
So we could see a big dip in inflation, but we're positioned
it's going to
for
take
it.
time. It's going to take some time.
Yeah.
I think the most probable is the next 3 to 6 months, we're going to see that inflation. We're at what, what did I say? 8.3. It's going to slowly tinker down into the 7s and into the 6s. That's assuming they don't, do something crazy. But it will slowly, we didn't get here overnight. We're not going to get out of here overnight. Nothing we're the largest economy in the world. Nothing happens quickly. So it's going to be a process, but our research partners, we knew this was probably going to be one of the last, if not the biggest print. We thought it could have been bigger than 8.5. We thought we could have been closer to 9. The thing that really made it fall off a cliff, used car prices went from, what was it? In April, they were up 22%, but in March, they were up 35%, which a 13% drop in month over month. It's massive. So that was the big swing. The surprising thing was energy. April was up 30%, and March it was up 32%. So that's even coming down. We forget about the impacts that this special military operation had on this whole year, but it had some massive impacts. It kind of inflation would have cooled much faster had the Russians not been a bunch of assholes.
Sure. Yeah, nobody expected that. I like the that you had mentioned in the newsletter about the ISM, which is the manufacturing
Yep,
data,
yep.
um,
That
hitting a
cooled.
20-month low.
Yep,
So yeah, that's one of the factors that you're also looking at in terms
yep.
of
You got to look at everything.
monitoring
I mean,
inflation.
how we called inflation when we started buying commodities in June and July and August of 2020, as we saw all those things. Those things front run all these government numbers, and I don't know how they missed it. I mean, like, it's not a secret that these numbers come out. I think they probably saw it and just either just didn't care, or they cared and they wanted to cool it off. They want to be the heroes. I don't know. I'm purely speculating on what these yahoos are thinking. I just follow the
Mhm.
data. I don't really care what they do. It's impossible to kind of figure that out. I know what they'll do when what the S&P's down like 17. What wonker number is it now? Yeah, 16 and a half, 17 or year to date. If that number doubles, they'll stop. uh, those guys believe that they will definitely stop. When that phone starts ringing, they'll change their tune. But
Sure, sure. Um, and just to remind the viewers and also, clients and non-clients, Sean looks at four different markets when it comes to investing. Equities, bonds, commodities, and
currencies.
currencies, right, Sean? Yeah.
Yep.
And commodities has
You're
been something that has been very vital to Sean's process.
It gives you a lot of insight on inflation, because that's that front runs everything. I mean, commodities are input costs. If input costs are rising, it costs manufacturers more to make their widgets. If that costs them more, it's going to cost the consumer more. So it's just,
Sure.
you got to really pay attention to the currency and the commodity space to get inflation right. If you get inflation right, you'll generally at a bare minimum not get your face ripped off. In the equity space, which we've seen.
Yep.
According to, was it Goldman Sachs's prime data as of Monday? It is Wednesday. I think the average hedge fund is down like 27% this year. It is wild. Yeah, yeah, it's not good. Yeah, if you were levered long tech coming into this year, hopefully you're still in business. Probably not.
And if you were in a traditional model like a 60/40, 70/30
Oh,
kind of
you're
thing,
you're in
you
deep
probably,
trouble.
yeah,
Yeah, this has been a
yeah,
weird year. I will admit this has probably been the most difficult quad four that I've ever dealt with, because so many things there's a lot of things going on underneath the surface that make things act differently. But like, if all you had was equities and bonds this year, it's been real rough because everything, those both have been real bad, not good.
yeah.
Like, even the thing that we're the heaviest in, and it's been done better lately, but treasuries have been acting very strange. That's for,
Hmm.
again, there's been a few things under the hood that's caused that. We still feel really good about it in the interim. Just in the immediate term, it's going to be choppy. It is kind of the nature of the beast. The kind of the there's a hurricane on us, and eventually it will pass.
Yes, it will. I'm pretty
Always
confident.
does.
And
Always
I
does.
know there's a lot of talk with the Fed and that affecting markets dramatically. They say a peep and the internet goes wild and it um, starts to mess with markets and investments even more. But great thing is that regardless of all of that BS out there, Sean sticks to the process. So just because the
I'd
Fed,
go crazy if I didn't. I'd go
yeah,
crazy because you'd just be guessing. You'd be chasing
yeah,
your tail every day. Like, believe me, I see what's said. I'm curious at what they're saying, but I don't take it into account. You can't. Like, I learned a long time ago. You can't. Don't listen to what they say. Watch what they do,
yeah,
because they will lie to you. Lie to you. Woo. Or no, they'll change their mind. But if we're honest with ourselves, they're spinning and spinning and spinning.
that's right.
The Fed has become
All right
a
then.
political beast.
So Sean, you had mentioned briefly about what we're in right now, gold, treasuries, bonds.
Doll-
Um,
dollars.
what dollars? What else is going on there? in our portfolios?
Like our most popular one, very low equities. We have 3% in equities in Indonesia.
Hmm.
That's the only equity exposure that we have. Again, yeah, a lot of dollars, a lot of gold, and a lot of treasuries, and then about half cash. Um, we have a ton of cash right now. And that's kind of buoyed a lot of our models. Dollars and
Uh,
golds. Go ahead.
why are we in so much cash in all the models, which ranges from conservative all the way to ultra aggressive?
Um, some of it has been the equity space is just extremely too volatile. Once the VIX gets north of 30, nothing really works, especially domestically. It's just an uninvestable spot. Some of our more aggressive models have taken shots at certain things, but for the most part, like it's the death bucket. You go in there and you need your face ripped off. It doesn't matter whether you beat your numbers or not. Like it doesn't matter because,
Hmm.
Captain Stock Picker, he's losing his ass on Tesla, so he's getting a margin call. So he's going to go over here and sell something that's actually working to cover the margin call over here. That happens all the time.
Hmm.
The system has never had more leverage in it than ever before. So
Hmm.
this blows away, the '08 and the tech bubble combined. So like the amount of leverage that's juiced into the markets right now, like there's so many unintended things that, this is affecting here because of this. There's a lot of those ripple effects.
Hmm.
But
All right.
I mean, I would have bought more treasuries if I could have, but we have like internal risk parameters that like, hey, this is the max we can hold for this model. So a lot of our things have just kind of capped out, and I've just been riding them the last few days. I will start. There is a certain level since this has been happening so fast. It was the 10-year yields at 292 right now. 36 hours ago, it was 317. So we've seen this real big rip down in yields, which means the prices have gone up, which is great for us.
Hmm.
But it's happened so fast that we're anticipating probably a pop back in the other direction, just a little bit of a mean reversion. So, I mean, if we keep going down this path with yields falling off a cliff, we might be a seller of treasuries here relatively soon. Not all of them.
Yay.
Some,
Yeah.
some,
Yeah.
some. You never sell everything. Never buy all of it. Never sell all of it. You
Of course.
some,
All
some.
right. Well, I was going to open the floor up to any questions that the audience may have. I haven't seen any come through in the chat box just yet,
Too
but
boring of a topic.
man, it's
The
funny, like the
Fed.
Fed is such a massive organization, right? That controls so much. I mean, that not controls so much, that controls all of the money circulation
They're
and interest
powerful. They've
rates.
gotten, in my opinion, too powerful.
Oh yeah.
The dot-com and especially the housing crisis, that those really, their hand grenade turned into what are those javelin? What are we sending over to the Ukraine? The tank busters, the javelin things that Lockheed Martin makes. So they just become too powerful and too talkative.
Yep.
Bunch of chatty Cathys.
Yep. And then everybody likes to chat about, comment on every sentence that they say. And so it just exacerbates the whole confusion. Um, but yeah, I mean, it's unfortunate that, the Fed is a boring topic. I'm gonna tell you, it's not very exciting, right? But
I'm aware.
it's
I promise you. I get. I'm the one that's trying to make this less boring, and it's not easy. I mean, I sit around and I think about it all the time, and I'm listening to other people that our research providers talk about it. So I'm
yep,
interested in it only because it matters. But I
yep,
look, if this wasn't my job, I'd probably never pay attention to it because it's
yep.
very dry and it doesn't make sense. And people, if it doesn't make sense and it's boring, no one wants to deal with that.
Well,
I
that's
get
why
it.
they have us. That's why our clients have us, right? And
I
they come
get
to
yeah.
us with questions. And
Hey,
I
I
think
don't.
for anybody who's, viewing this webinar that works with an advisor, they should be aware of what's going on at the Fed, you know, and kind of what they're doing about it, you know, um, whether it's sticking to a process or something else. But I think
I
it's
don't know how
very
you could do
important that
anything
they're
else.
aware.
Like,
Well,
if you're building your portfolios around what you think the Fed's going to do, you're not going to be in this business very long. You're not. You're just going to. You're.
of course, I mean, just it being an aspect, right? Like just being aware of what's going
Yeah.
on, you know?
Aware is good. Aware is good.
Yeah. aware is great. But anyways, I don't see any questions coming through. So we'll wrap this up for today.
Cool.
If anybody does have any questions, please feel free to send us an email, Sean or myself, or you can send it to info@nestfinancial.net. If you're interested in having a look, having us look at your portfolio, or if you have investment questions, please feel free to call or send us an email, and we would love to sit down with you. One other thing is that in addition to investment management, we also do financial planning, meaning that we look at your entire financial life, look at where you're at, where you want to be, and help you map out how to get there. And so if that's something that you're interested in, whether you're starting a family, starting to go into retirement fairly soon, please reach out to us. We would love to have a conversation with you. But other than that, once again, just have to remind everyone, this webinar is for educational purposes only, and it is not investment advice.
Nope.
If there's anybody who's looking for investment advice or needs some yourself, again, please feel free to reach out. That's all we have for today, and we hope that we can see you on the next one. Thank you.
Adios.
See you later.